anyway, if we can prove this source rock kitchen is working, similar to what we're talking about in the tertiary, there are a lot of other traps here. You can see, even on this, there's a big truncation trap here with bright spots. There's tertiary play here with looks like hydrocarbon anomalies, tilted fault blocks over here. So the key on these basins is opening them up. Once you prove the system works, there's a lot of running room in each one of them. Move to the Jurassic. This one is Horn Petroleum. People keep asking me, why does Horn stock do what it does? And I have to tell you, I have no idea. It went up 60% in a day this week on no news at all. We're basically done drilling and we're demobilizing our rig. So there is no news. I mean, there was a Somali presidential election that day. That's about the only thing I can say. So we tend to trade the Australian market. We've got 2 Australian partners that are listed on the Aussie exchange, and they tend to turn over their entire share register every 6 weeks or so. So I think there's a lot of speculation in this stock. So it's hard to predict what the shares do in Horn and try to understand why they do what they do. The play itself, though, is an extension of the Yemen Rift. This basin just opened up about 12 million years ago, so in the Jurassic and Cretaceous, when all these oil fields were formed in Yemen, they were actually continuous basins. If you take a well log or a seismic line from here, you can actually correlate it directly to Yemen. So it's identical geology, but very underexplored. Only really 2 wells drilled in the Nogal Basin, and only 1 kind of shoulder well drilled in the Darur Basin. So very, very immature. We did drill 2 wells. I mean, one of the first things, of course, being in Somalia is, when we first started going in there, the question was asked to ourselves and to others, can we get in here and operate safely in a very difficult working environment. Northern Somalia is much more established than southern Somalia. We have gone in 2009, we shot seismic, and we have drilled 2 wells now without incident. It is a difficult area, but we think it's an area we can work in. The 2 wells we drilled, unfortunately, I think last time I was here, I told people, we had good oil shows, we had good log indications. I think I made the statement that I've flowed oil from wells that had much poorer indications, but I've flowed water from wells that had much better indications. Unfortunately, the latter came true, and we flowed water from what was the best sandstone that we saw. So both wells are drilled on faulted traps here. The good news is everywhere we see porosity in sands, we see oil shows. So there is an active working petroleum system here. There is oil coming through the system. There are good reservoirs. The sand tested water. We tested water at almost 2,000 barrels of oil per 2,000 barrels a day rate, which indicates good reservoir. There are nice thick seals, big thick anhydrites, big thick carbonates and shales. So we've got 3 of the 4 components we need basically to get hydrocarbon accumulations. Unfortunately, fresh water is always a problem. When you log a well, you're basically measuring the resistivity of the formation. So you send out an electric signal into the formation. Salt water is very conductive, so if you send it out into salt water, you get very low resistivity. You get most of that current back. If you send it out into oil, it's not very conductive, and it's highly resistive. So that's generally how we tell oil from water when we're logging, is the resistivity of the formation. But the problem is if you have very fresh water, which we did, we have about 1,200 ppm water, which is basically meets drinking water quality standards. It is also very non-conductive. So you can get fooled by that water into thinking you have oil. We went and tested the best zone in the well, in the Shabil North well. It was better than any zone we had in the Shabil well, and therefore it was decided that it wasn't worth going back to test this well because the indications were poorer in this well than they were in this. So I'd say we're disappointed that we didn't flow oil. I think one has to keep in mind in the North Sea, it was the 59th well that actually found the first commercial oil in the North Sea. So it is very rare to come into a basin, drill the first wells, and find oil. But we're very encouraged that we've got a good petroleum system, we've got good reservoirs, we've got good seals, and we are going to continue here. We have given notice to the government that we're electing to the next phase. They approved that extension today, and we're going to go in on the northern block. We're going to come in and shoot some more seismic to get some different types of traps that aren't these tilted fault block traps that have faults coming to the surface. I think these leaked similar to what happened in the Cretaceous in Block 10A. And in the southern block, we actually have a good drillable prospect. There's some border issues that we have to resolve here to get access, but we don't need to shoot more seismic. We just need to drill a well. So the real focus now will be going out and really finding a partner or finding funding. We're going to be down to about $5 to $7 million in the company after this. So we think we'd like to go out and try to find a partner. We do have 3 companies that have contacted us who are interested in coming in. So that'll be the real focus here. We will go raise money in the market if that's not successful, but it won't be that easy after the testing water out of these wells. The other thing with Horn is it may be a vehicle that we can use to do some more new ventures. So I'm a bit reluctant to do many more new ventures in Africa Oil because, you know, what I've said to my guys is they have to show us something that's better than what we've got. Otherwise, we're effectively diluting our shareholders on these good plays that we have. If we, you know, raise equity or give equity away. So this may be a good home for some of the new ventures that we see around the area. I can assure you, as if there are Horn shareholders in the crowd, we are going to be spending some time trying to get Horn up and running. As I said, in August we did a new resource report. We hadn't done a resource report in 18 months, and we'd shot an awful lot of seismic and shot FTG and identified a number of new prospects. And that's the main reason we had such a big increase. We went from 11 billion barrels gross to 28 billion barrels gross, 142% increase. Net to us went from 5 billion to 12 billion gross, 128% increase. And it's mostly because we did not include South Omo, we did not include 13T, we did not include 12A in our old resource assessment. The other thing that's interesting is our geological chance of success. Before we drilled the Gamia well in the whole Locatar subbasin, all of the prospects were deemed to have a 14% chance of success. Now they're 34 and even up to 39% chance of success. So that kind of shows you what we're trying to do here is de-risk these basins. If we're able to drill wells in those other sub-basins and find oil, it will change the numbers similarly. So what we have now without Puntland is about 1.1 billion barrels of risked resource net to us. And I think when we first started talking about this, I've always said about 500 million to 1 billion barrels was our target coming in. But I think even now just drilling one well, we're starting to see that our reserve auditor thinks we're on a risk basis, we're already starting to see that type of target. So this just breaks down per block where the resources are, and you can see there's some very big ones here in the tertiary. The biggest being 10BA, 9.8 billion barrels. A lot of it in 12A as well. You will note we did some farm outs in that 12A. It does seem geologically a little more complex and surface-wise a little more complex. You can see the risk number is fairly small for this, even though the resource number is fairly large. But together, again, 22 billion barrels just in the outside of Somalia, and you can see why we're still interested in Somalia, particularly in Nugal. There's still a lot of resources there, and there's still a lot of potential. It is a difficult place to work, but geologically we see a lot of potential in there. So it's very difficult to value a exploration company, and I get questions all the time. You know, how do I value Africa Oil? How do we think of it? I mean, these are explorations, so there is a fairly large risk factor. If you just take our total resources unrisked, we're trading at about 16 to 18 cents a barrel. But that's probably not that bad, to tell you the truth. I mean, these are fairly risky barrels, and I think the market tells us that. If you take on a risk basis, you start getting about $1.50, $1.60 a barrel, which I think is getting a little more reasonable. These are still, I think, fairly conservative numbers. If you look at the Heritage Tullow transaction that was done a little over a year ago, they paid $4.23 a barrel of 2C resources in Uganda. And Kenya has better contract terms and it's closer to the coastline. So barrels in Kenya should be worth more than barrels in Uganda. So we kind of keep a $5 to $6 target. Some of the analysts have said up to $8, $9 a barrel, but it's pretty subjective. It depends on how many barrels you have, what the pipeline's going to cost, what the development's going to cost, what they flow at. So it's still early days. It's hard to pin down a number, but I think certainly no less than $5 a barrel is probably a good rule of thumb in Kenya. So if you do some math, you get some kind of silly numbers. You take that 10 million, 12 million and multiply it by that, you get 50 billion dollars of potential value that we're chasing. But this, of course, assumes that every single well we drill is going to be successful, which is not a reasonable assumption. If you take this number and multiply it, that's probably something that's a little more reasonable, which is about $5.3 billion of value on a risk basis. So we think this is kind of not an unrealistic target. We're trading for about $2 billion now, so even though we've made a pretty high run, we've gone from $1.15 up to, I think we're at $10.40 today. We still think there's a lot of running room just on a risk basis. And really what our job is to de-risk this portfolio. So the dozen wells we're talking about drilling will come a long way to moving a lot of these unrisked barrels into risked barrels and ultimately to contingent resources, because that's what eventually is going to be worth something when we move these barrels into 2P or contingent resources. So that's the goal in the next year, and we certainly have a lot of wells to do that. From a financial side, we've got about $60 million cash in AOI right now, as at the end of June. We'll get another $35 million when the Marathon farm-out deal closes, so we'll be close to $100 million. We will need to raise cash, and we do plan to do a financing sometime this fall. I think we want to time it. We'd love to see the results of Twiga well before we do that, and I think we are looking at doing a private placement sometime this fall in the neighborhood of about $200 million. So the goal of that $200 million is to see us through at least 12 wells. And then I think after we've drilled those 12 wells and we have an idea how big this thing is, we'll have to have another meeting of the minds about what we do going forward. Right now, the idea is to go forward and actually go into development and do development. I think with Lundin Petroleum, the Lundin family is now getting more comfortable in doing downstream production development. I think Lucas likes the idea of this $1 billion a year cash flow coming out. Getting at the ripe old age of 53, I think he's starting to think maybe it's time to be settled down and just enjoy cash flow instead of going off and going into the wild again. So I put this up. A lot of you are familiar with these companies. I've been involved in every one of these companies except Redback. We kind of cheated and threw it in a gold mining company there just because it was such a good deal we couldn't resist. But you can see there's been just a massive increase in value here. We've gone just in these companies alone from 173 million to 21 billion, an average share price increase of 32 times. Obviously, the Tanganyika and Valkyries were ones that we sold off. With what's going on in Syria, we're quite happy we sold Tanganyika off when we did. We went from 50 cents a share to 31.50 and market cap of 13 million to 1.9 billion. Valkyries again we sold off when Russia wasn't quite so bad, and the Russian